Today, we will talk about how to create cash flow. If you own a business and your sales or top line are growing at a rampant pace and you're increasing profits each year, you're certainly headed in the right direction. But don't put your guard down. Even growing, profitable companies can be hit with cash flow problems if their finance, operations, and/or investing activities aren't running efficiently. 1. Choose a time frame and method to use. Each statement of cash flows corresponds to a specific accounting period. You may prepare your statement of cash flows quarterly, semi-annually, or annually, depending on a business plans and needs. 2 methods, direct and indirect, help calculate changes in cash in the statement of cash flows. The direct method, also called the income statement method, considers all cash receipts and payments, including cash receipts from customers, payments to suppliers and employees, and income taxes and interest paid. The indirect method uses accrual accounting information and includes revenue and expenses when a transaction occurs rather than when payment occurs. It involves adjusting net income to reflect changes in non-cash transactions by adding or subtracting their differences. These non-cash items feature changes in assets and liabilities on the balance sheet for a particular duration, allowing for reconciliation between the income statement and the balance sheet. Consider identifying any increases and decreases to asset and liability accounts and adding them back to or removing them from the net income figure for an accurate cash inflow or outflow. 2. Collect basic data and documents. Before you prepare your cash flow statement, you must have all the basic and relevant financial documents. These include income statements or profit and loss statements, balance sheets, and statements of equity changes. Check for non-cash and other material transactions in the cash and bank account ledgers and from other departments. You may need the previous cash flow statement for potential adjustments that are necessary for business operations. 3. Calculate balance sheet changes and add them to the statement of cash flows. This process involves getting the opening and closing balances from the balance sheet and calculating their differences. Ensure you have the correct figures before transferring them to the cash flow statement by making sure the sum of all balance sheet changes amounts to 0. Depending on the details needed in the statement of cash flows, you may use your general ledger to get more accurate figures. For instance, if you have the expense in machinery purchase as -$5,000, you can enter this amount in your statement of cash flows under cash flow from investing activities. The statement of cash flows reflects a decrease in accounts receivable from the balance sheet by adding it to net earnings and subtracting an increase in accounts receivable from net earnings since they aren't cash. For inventory, you deduct an increase from net earnings since it implies spending more cash and add a decrease in inventory reflected by credit purchases, an increase in accounts payable. Do the same for other incomes and expenses, such as taxes payable, salaries, and insurance, by subtracting the differences from net earnings for those paid off and adding differences for those still owed. 4. Adjust all non-cash expenses and transactions. Check for non-cash transactions in the income statement and other financial records and record all adjustments. Non-cash expenses include capital depreciation, bad debts, and investment gains or losses. Consider converting the net income on your income statement to a cash basis to get the actual cash related to business operations for your operating activities section of the statement. Since leasing supplies, equipment, and real estate usually ends up being more expensive than buying, doing so may seem counterintuitive to someone who is only paying attention to the bottom line or your income after expenses are paid off. But unless your company is flush with cash, you're going to want to maintain a cash stream for day-to-day operations. By leasing, you pay in small increments, which helps improve cash flow. An added bonus is that lease payments are a business expense and thereby can be written off on your taxes. 5. Complete the 3 sections of the statement. You can prepare a statement of cash flows after getting all the information on operating, investing, and financing activities. A positive balance shows a healthy business and it's liquid. A negative balance shows more outgoing than incoming money. Businesses with a negative balance need more cash from investing and financing activities to cover the inadequate cash from sales to pay for expenses. You may get a negative balance if you spend more cash investing in assets for future returns, such as equipment. 6. Net income. The statement of cash flows shows net income before preferred dividends. Net income from the income statement can be positive or negative, depending on how much money the business makes and its expenditure. Taxes and interest on debts are examples of costs subtracted from gross income to get the net income. Think power in numbers and find other like-minded companies willing to pool their cash in order to haggle lower prices with suppliers, who usually give big discounts to large firms who buy in bulk. 7. Working capital. Working capital affects cash flow operating activities, representing the difference between current assets and liabilities other than cash. There's no change in working capital if a transaction increases current assets and liabilities by the same amount. For example, current assets increase when you purchase more inventory. 8. Dividends. Dividends involve owners and affect cash flow, making them part of financing activities. You subtract them from cash when issued. It's important to record dividend issuance on the statement for accurate results. 9. Cash flow from investing activities. Cash flow from investing activities includes details related to the purchase and sale of long-term and non-cash equivalent assets, such as properties, equipment, facilities, and issuing of stocks. You can consider lending money and collecting loan payments under investing activities. Consider investing activities that involve cash, not debt. 10. Cash flow from financing activities. The last section in a statement of cash flows includes information on financing activities, such as debts and equity. For instance, it shows money borrowed and repayment, dividends paid, and stocks issued. You can calculate the amount of cash generated or spent from borrowed funds, credit repayment, and purchases of an asset. Accounting for non-current liabilities and equity can help you understand their effect on cash flow and working capital. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.